Before you buy anything in 2026, you've got to watch this. Whether you're a landlord looking to buy, looking to sell, I'm breaking down what's happening to UK house prices. Have you invested in the wrong area? Are we heading for a crash? Where are the best rents, best returns on investment? I'll show you where the numbers still make sense and where you should probably walk away. Everyone's been asking, is the UK housing market finally about to crash, or has it already recovered? Because on the surface, things are actually looking pretty strong. Based on data published by Rightmove, the average new seller asking price is now about £368,000. That's an increase of 2.8% in a single month, so they've gone up about £10,000. Now, although that seems minor, it's actually the biggest January price increase on record, and it's the biggest monthly jump in over 10 years, 2015 to be exact. Alongside that, the number of homes listed on Rightmove increased 81% in the 2 weeks following Christmas. Now, it's normal not to want to sell during Christmas, but that is a big jump. So sellers have come out in full force for 2026. Of course, we had the budget last year. That was a lot of fun. But prices are now back to where they were, roughly speaking, in August 2025, when we saw that sort of little bit of a wobble because of the nerves around the budget. So if you were sitting there waiting for a massive house price crash, this isn't what one looks like. On the finance side, things are looking a little bit better too. Average 2-year fixed rates are probably around about 4.2, 4.3. Over 5 years, about 4.3, 4.4, which it's not amazing, but it's a lot more comfortable than last year. So what are most forecasts saying? A boring year. Small positive growth, maybe 1 to 2%. Rather than a massive boom or a massive bust. So that's very different compared to what's in the headlines, which make out prices are skyrocketing. In reality, we've had a good start to 2026. Be interesting to see how that develops over the next few months. Interest rates for mortgages are more comfortable than what they were this time last year. I know affordability for mortgages has gotten a little bit more straightforward as well. So with the increased supply that we've got on Rightmove, Zoopla of people that are looking to sell, all of these factors combined will obviously help and provide a good year of growth in terms of the property market. So all of this will vary from area to area, but make sure you stick around for the rest of the video because I'll help you identify what part of the property cycle your area is in. Is it somewhere where you might not see huge growth? Your money could be used better elsewhere. But I'll also be going through where you can achieve some of the better returns on investment dotted over the UK. So you won't want to miss that. So as we all know, property doesn't just go up forever in a straight line. It moves in a cycle. So you have the recovery phase where prices creep up, people get confident. You've got the boom phase. That's where credit starts to become cheap. People have fear of missing out. Prices race ahead of wages. This eventually reaches a peak where properties are being bought for massively over what they're actually worth, leading to a downturn where lenders are tighter in terms of the money they're lending, property prices are falling in real terms, and then back into the recovery phase again. Here's the key thing that almost everyone misses. So different parts of the UK are at different stages of that cycle. So some would say that London and parts of the south hit the boom phase years ago, where prices shot way ahead of local incomes, rental returns, rental yields, they got tighter, and now it is quite tough to earn a decent level of profit in certain areas of the south and in London. Meanwhile, a lot of the north and the Midlands are earlier in that cycle. Prices are more realistic compared to local wages. Rental returns are stronger and there's more room for growth if you buy well. So the real question in 2026, it isn't, is the housing market crashing, yes or no? It's which part of the cycle is your area in right now? Because if you get that wrong, it means you're overpaying in a finished low yield area, or you completely miss opportunities that come up that could see some high levels of growth in the near future. Once you're able to see that, that's when the north versus south divide suddenly makes a lot more sense. In terms of what we're seeing, people still love investing in the south. So London, the home counties, the south coast. And it can make sense. If you're doing a buy, refurbish, refinance and you live 5-10 minutes down the road, obviously that's going to make a lot more sense than buying a property in Liverpool, Leeds, as an example. So let's take your typical commuter town in the south. So Reading, somewhere where there's good infrastructure, good growth. So you might pay around about 350,000 for a pretty standard 2-bed. You rent that for, let's say, £1,200 a month. That's around about a 4% yield. Usually, I'm a fan of return on investment, but not going to go into that on this video. But yeah, that's factored in before any maintenance, any voids, rising insurance, compliance costs. Yes, you might be paid a little bit more in rent than other areas, but it's not going to be proportional to the amount of money you put in. Just because you paid double the stamp duty, double the deposit, it doesn't mean you're going to get double the rent. Now, let's compare that to the North and the Midlands. So in a northern city, so let's take Manchester, Leeds, you might pay about 120,000 for a 2-bed. Rents of £800 to £900 a month, they're more realistic. And suddenly you're looking at a 7 to 8% yield, where tenants actually feel a lot more comfortable with those rent payments. And of course, the Midlands and the North has also seen some greater appreciation in terms of house prices and rents compared to the South, which has slowed down a little bit in recent years. Of course, there are always exceptions to this. Timing, purchase price, you as the investor, the deal itself. It's not to say that properties in the South don't work, but personally, I'm focusing more of my time on properties in areas that are a decent price, that are a decent return on investment, that tenants aren't too stretched and has good potential for growth. So let's put some actual numbers to this. Where can you get some better returns on investment? So the numbers I go through, they're representative averages for 2-bedroom properties in town centres or postcodes that are high in demand. But obviously with averages, there are going to be some higher examples and some lower examples. First up, Manchester. So typical 2-bed, investor-friendly area. You might find properties around 180,000. Rents achievable of about £975 a month. That gets you a 6.5% gross yield. So for me, that's the kind of profile I like. So not dirt cheap, still affordable, some good, strong rental demand, and yield returns that actually give you a little bit of a cushion after costs and tax. Next up, we've got Leeds. In prime investment areas, you could look at a 2-bed for around 200,000. Rents are quite strong, fetching about £1,250 a month. That gives you a gross yield of about 7.5%. For investors, nice balance of a big city, jobs, numbers that make sense. Going on to Liverpool, wide range of properties in Liverpool, but you might find a 2-bed for about 150,000 in areas with good rental demand, getting rent of about £810 a month. That gives you a gross yield of about 6.5%. Upsides there, you do have to be a little bit more picky. Some postcodes are great, but then some you do want to avoid, so you do need to do your homework on it. So now for Birmingham. So prices here, they're a little bit higher, so around about 250,000 for the same kind of 2-bed. Rents are strong, getting about £1,150 a month. So you're getting a gross yield of about 5.5%. So not as juicy as some of the northern cities, but of course it's still better than you can get in some other places. Now let's have a look at the southeast. So if we were to look at the southeast, average prices here can be about 350,000 for a fairly standard 2-bed. Rents may be about £1,170 a month, which sounds good until you do the maths and you're only getting about 4% gross yield. Obviously, your deposit is bigger, your mortgage is bigger, the risk is bigger, the returns you get are smaller as a result. So you can see it all there, and this is the whole point of this video. Same country, similar properties, completely different stages of the cycle, completely different outcomes. So what do you actually do with this information? Here's how I'm thinking about my own portfolio in 2026. If an area has high prices, weak yields, tenants already on the edge, then I'm steering clear. It's about managing my risk. I've got my areas that I've always invested in. They are based more up north, and it's probably something I'm going to continue with because I've got the people that I work with up there. So that's where I'm going to continue focusing in on my research. But it's not always strictly about return on investment. It's also about what works for you. This year is my year to be boring, mathematical, get some good growth in. As we all know, there's a lot of changes on the horizon. I need my portfolio to give me flexibility so I don't leave myself in a tough position. Because the risk now isn't our UK house price is going to go to zero. The big risk is overpaying in the wrong area and spending the next 10 years watching your returns get eaten by new taxes, new regulation, and an area that just doesn't perform well at all. That's my take anyway. Do you think we're headed for a crash? I'd be really interested to know, to be fair, where you're investing in or considering investing in. Pop it down in the comments. Manchester, Leeds, just put the name of the city. But if you found this helpful, please, if you could hit the like button. And if you're after videos like this to do with buy-to-let, personal finance, If you want to join me on my journey to buying another 2 rental properties this year, I definitely consider subscribing as I bring you along on that journey. If you're interested in other videos like this, check this one out up here. But other than that, thank you so much for watching, and I'll see you in the next one. Bye-bye.